Hello everybody, my name is Mickey Payne, the Vice President of Investments at WNBC. Today I'm excited to present our third quarter market commentary. We hope you enjoy it and eagerly anticipate any feedback you might have. We are committed to providing you with information that we hope you find valuable. In this quarterly market commentary, our goal is to update you on key highlights in the economy and the changes that took place in each of the investment models during the last quarter. So, without further ado, let's get started. Despite initial 2023 forecasts anticipating a recession, the U.S. economy has demonstrated resilience throughout the third quarter of 2023. However, third quarter presented challenges marked by losses in both stocks and bonds due to higher interest rates, tighter lending standards, and elevated energy prices. There are three key highlights I wanted to point out about the economy last quarter. One, the labor market remains robust, with the number of Americans filing first-time claims for unemployment benefits ticking up slightly, but still hovering near historically low levels. While the labor market remains strong, the lower number of job openings and a reduced quit rate indicates that higher capital costs of capital have led employers to closely scrutinize expenses. Two, the confidence of American consumers has dipped in September, especially regarding the future. Amid expectations that interest rates will remain elevated for an extended period of time, the Conference Board, which is a business research group, reported that Consumer Confidence Index fell to 103 in September from 108 in August, with analysts expecting a smaller decrease to a reading of 105. The index assesses both American perception of current economic conditions and their outlook for the next 6 months. Most concerning about this is the decline in the index measuring future expectations, which plummeted to 73 in September from 83 in August. Historically, reading below 80 for future expectation signal a recession within a year. 3. In July, the Federal Reserve Board issued a statement raising interest rates by 25 basis points for a target range of 5.25% to 5.5%. Experts suggest that the Fed might end up going on a prolonged pause because the U.S. economy has not fully adjusted to the higher rates just yet, and that may take a full year for the full effect of a rate hike to hit the job market. Since then, there have been no other interest rate hikes as the Federal Reserve closely monitors key economic indicators. The looming question remains whether a recession is on the horizon and when it might occur, or if at all. Nobody knows exactly when the Fed will stop raising rates. However, both markets and the Fed itself project its key policy rate to peak near current levels and then decline around 100 basis points by the end of 2024. So if you believe that the Fed is finished or nearly there, what does history tell us? An analysis after the last Fed hike reflects cash investments decayed while stocks and bonds flourished. You can see here in the chart. Now, past performance is no indicative of future results, but this is just an analysis of what history tells us. So we're moving from economic information to the models and what changes occurred last quarter. And the first model that we're talking about is the WNBC quantitative model. This model is designed for risk managed performance over the long term by using several technical indicators. We review these indicators daily to tell us whether we should be in the market or out of the market in bonds, or minimally or maximally allocated to equities. This indicator primary focus is to identify a high probability of disturbing the markets, with a primary focus to help you protect you from the potential downside in the markets. In Q3, the model maintained its maximum equity exposure, while the fixed income allocation continued to remain in cash. However, in Q1 of 2023, the investment committee saw that the Federal Reserve was unloading treasuries to clean up the balance sheet, so we've been investing in treasuries since then. Any treasuries that have matured, we are reinvesting into the 9-month treasury, currently yielding about 5.45%. As you may or may not know, about another benefit of buying treasury securities is the interest rate is state exempt, meaning you don't have to pay taxes, state taxes on it here in California. On the equity side of the model, it's called to sell the iShares MSCI EFA and use that cash from the sell to reallocate it proportionally into the existing equity investments. The next model is the WMB Strategic Hold Portfolio. This is designed to help investors pursue long-term investment success through fundamental research by the American Funds team. American Funds research includes thousands of face-to-face meetings with companies throughout the world. They visit factories, facilities, and headquarters to help drive deep operational understanding and inform portfolio asset allocation. And a long-term approach coupled with extensive fundamental research has allowed American Funds to generate strong results versus their peers. In Q3, their key investment theme includes increasing emerging market equity exposure in globally oriented capital appreciation focused portfolios, increase higher yielding dividend exposure relative to core equities and equity oriented growth and income portfolios, increase return seeking fixed income relative to core fixed income in select growth and income portfolios, and manage duration profile and preservation in more conservative retirement income focused portfolios. And so the changes made in Q3 were just in the American Funds Tactical Income Preservation Model, and they sold the American Mutual Fund and replaced it with the Capital Group Dividend Value ETF. The next model we have is the LTAM Tactical Model. This model is an actively managed portfolio strategy that shifts the percentage of assets held in various asset categories to take advantage of market pricing anomalies or strong market sectors. This strategy allows the portfolio managers to create extra value by taking advantage of certain situations in the marketplace while maintaining your long-term investment goals. Managers return the profile to its original asset allocation once reaching the desired short-term profits. And in Q3, the key investment theme, there was no changes in both in the equity portion or the fixed income. The next model we have is the WMBC Alternative Model. This model is actively managed multi-strategy alternative investment portfolio. Our model seeks to provide you with access to unique investment opportunities that produce returns with a low correlation to traditional investments. We have two alternative models. One, the alternative income, which is more focused on generating income, and two, the alternative growth model, which is more focused on generating growth. The alternative model is currently made up of institutional access to a commercial real estate and institutional access to diversified portfolio of credit instruments and a hedge fund that is focused on long-short equity investments. So in Q3, after extensive research and discussion, the investment committee agreed to invest the cash into Treasury securities for now. We continue to look for opportunities, but take a conservative approach as the market digests this year's quantitative easing by the Federal Reserve. Well, there you have it, friends. Those are all of our models, and that's our Q3 market commentary. We hope you enjoyed this format. If you have any questions regarding your investments, feel free to contact your advisor. Thank you for the opportunity to serve your investment needs.